In just 1 or 2 years, millions of UK pensioners could be forced to pay income tax for the first time in their lives, not because they're rich, not because they've done anything wrong, but because the government quietly froze one number and kept raising another. If you rely on the state pension, or if your parents do, this affects you. Stay with me to the end, because once you see what's coming, you'll never look at your pension the same way again. If you're watching this thinking, why is nobody explaining this properly? That's exactly why this channel exists. This channel is for people like you, ordinary people who've worked hard, played by the rules, and just want straight answers without political spin or confusing jargon. I break down pensions, tax changes, and government decisions in plain English, so you know exactly how they affect your life, not just the headlines. I'm going to keep uploading videos on this exact issue: the state pension, tax traps, allowance freezes, and what's really coming next, so you don't get caught out later. If this matters to you, if this affects your future or your family, do yourself a favor and subscribe now. This channel isn't for everyone, it's for you. I'm going to keep uploading videos on this exact issue: the state pension, tax traps, allowance freezes, and what's really coming next, so you don't get caught out later. If this matters to you, if this affects your future or your family, do yourself a favor and subscribe now. This channel isn't for everyone, it's for you. Let me explain how we got here in simple terms. The government set something called a personal allowance, which is basically the amount of money you can earn each year before you have to start paying income tax. Right now, that amount is £12,570. Anything you earn above that figure, you pay tax on. The problem is that this personal allowance has been frozen at £12,570 since the 2021 to 2022 tax year House of Commons Library, and it's going to stay frozen until at least 2031. Meanwhile, the state pension keeps going up every single year because of something called the triple lock guarantee. The triple lock means the state pension increases each year by whichever is highest out of three things: the rate of inflation, the growth in average wages, or 2.5%. For April 2026, those on the full new state pension will receive £241.30 per week, which equals £12,547.60 per year, standard life. Do you see the problem now? The pension is rising, but the tax-free allowance is staying completely still. Think of it like this. Imagine you have a glass that can hold exactly 12,570 pounds of water before it overflows. Every year, the government is pouring more and more water into that glass because of the triple lock, but they're not making the glass any bigger because the personal allowance is frozen. Eventually, the glass is going to overflow, and when it does, that overflow is what gets taxed. We're literally just 22 pounds away from that happening right now, and with the state pension set to rise again next year and the year after that, it's almost certain that within the next year or two, the state pension alone will exceed the personal allowance. When that happens, every single pensioner whose only income is the state pension will suddenly find themselves having to pay income tax, even though they've never had to do this before in their entire retirement. Now, you might be thinking, surely the government wouldn't let this happen. Surely they'll do something to fix it before we get to that point. Well, the government has announced that pensioners whose sole income is the basic or new state pension would not have to pay small amounts of tax via simple assessment from 2027 to 2028 if the new or basic state pension exceeded the personal allowance from that point. House of Commons Library. But here's the thing, this doesn't actually solve the underlying problem. It's more like a temporary patch or a workaround rather than a proper fix. The government is basically saying that yes, technically you owe tax, but we won't make you pay it if your only income is the state pension. However, this creates all sorts of unfairness and complications that we'll talk about in a moment. Let me paint a picture of who this affects and why it matters so much. There are millions of pensioners across the United Kingdom who have worked hard all their lives, paid their national insurance contributions faithfully for decades, and are now living on a modest state pension. For many of these people, the state pension is their only source of income. They don't have big private pensions or investment income or rental properties. They're living on what the state provides, which for most people is barely enough to cover basic living costs as it is. The idea that they should now have to start paying income tax on this already modest income feels like a betrayal of the social contract they believed they had with the state. They paid in when they were working, and they expected to receive their pension tax-free in retirement, just like generations before them did. But it's not just about the money, although that's obviously important. It's also about the complexity and the stress this creates for older people. Pensioners in this position may be required to complete a self-assessment tax return, or for those with straightforward tax affairs, HMRC may send someone a bill for the tax they owe under simple assessment. House of Commons Library. Now imagine you're 75 or 80 years old. You've never had to deal with tax returns or communications from the tax office before, and suddenly you're getting letters about simple assessments and tax codes and calculations. It's confusing, it's stressful, and for many elderly people, it's genuinely frightening. They worry they've done something wrong. They worry about penalties. They don't understand the forms and the jargon, and they often don't have anyone to help them navigate this new bureaucratic maze. Even worse, the situation creates unfairness between different groups of pensioners. RamSafe. You've got people on the old state pension who receive lower payments, and they might have made extra contributions over the years to top up their pension, but they're still getting less than people on the new state pension. Then you've got people with small amounts of personal pension income, as well as their state pension, who will have to pay tax and file tax returns, while their neighbors who only have the state pension might not have to pay anything at all, even though they're getting the same or even more total income. And then you've got workers who are earning similar amounts to what pensioners receive, but these workers have to pay both income tax and national insurance contributions on earnings above the personal allowance. So you end up with a system that feels deeply unfair to almost everyone, just in different ways. Let's talk about what this actually means in pounds and pence for real people. If your state pension goes above the personal allowance by, let's say, £500 in a year, you would owe 20% tax on that £500, which is £100. Now, £100 might not sound like a huge amount to some people, but for a pensioner living on a tight budget, that's a significant sum of money. That could be several weeks of heating in winter, or a month's worth of groceries, or the difference between being able to afford essential medications and not. And remember, this is tax on money that previous generations of pensioners never had to pay. It feels like a new tax specifically targeting older people, even though technically it's not a new tax. It's just the existing tax system catching up with rising pension levels because the tax thresholds have been frozen. The freezing of the personal allowance isn't just affecting pensioners either, although they're particularly hard hit. This policy, which is sometimes called fiscal drag or stealth tax, is pulling millions of working people into higher tax brackets as well. When wages go up, but tax thresholds stay the same, more of your income gets taxed, and you might even get pushed into a higher tax bracket where you pay 40% instead of 20% on part of your income. The government collects billions of pounds in extra tax revenue this way without ever having to announce a tax rate increase. It's a politically convenient way to raise taxes because most people don't really notice it happening until they sit down and do the calculations. But for pensioners on fixed incomes with no way to earn more money, the impact is particularly harsh. So what can be done about this? What are the solutions that people are talking about? Well, there are really three main fixes that are being proposed by campaigners, charities, politicians, and pension experts, and each one has its own advantages and disadvantages. Let's go through them one by one so you can understand what might happen and what would work best. The first fix that people are calling for is to make the state pension completely tax-free, just like other benefits are. A petition to Parliament argued that income from state pensions should be tax-free in the same way that benefits are. Petitions. This would mean that no matter how much the state pension rises in future years, pensioners would never have to pay income tax on it. It's a simple, clean solution that everyone can understand. You get your state pension, and it's yours to keep, with no tax deducted and no forms to fill in. This would remove all the complexity and unfairness we've been talking about. It would give pensioners certainty and peace of mind. They would know exactly how much money they're getting each week or each month, with no nasty surprises at the end of the tax year. The argument in favor of this approach is that the state pension is supposed to be the foundation of retirement income, providing a basic standard of living for people who have contributed throughout their working lives. It shouldn't be subject to taxation when other benefits that people receive aren't taxed either. However, there are arguments against making the state pension tax-free as well. The main one is cost. The government would lose a significant amount of tax revenue if they exempted all state pension income from tax. Remember, more than half of pensioners already pay some income tax because they have additional income sources like private pensions or part-time work on top of their state pension. If you made the state pension tax-free for everyone, you'd be giving a tax break to millions of people, including many who are quite well off financially. The government argues that they need this tax revenue to pay for hospitals, schools, and other public services. They also point out that the state pension is a form of income, replacing the salary you used to earn when you were working, and salaries are taxed, so why shouldn't pension income be taxed too? That's their logic anyway. Critics of this approach say it would be expensive to implement and would benefit wealthy pensioners just as much as poor ones, which doesn't seem fair either. The second fix being proposed is to raise the personal allowance significantly, potentially to something like £20,000. Now, there have been some reports and discussions about the possibility of raising the personal allowance to this level, although it's important to understand that the government has stated it has no plans to increase the personal allowance to £20,000, noting that this would come at a significant fiscal cost of many billions of pounds per annum and would reduce tax receipts substantially. UK Parliament. But let's talk about this option anyway, because it's one of the solutions people are discussing. If the personal allowance was raised to £20,000, that would mean everyone, not just pensioners, could earn up to £20,000 per year before paying any income tax. A pensioner receiving £15,000 per year currently pays tax on the portion above £12,570, but under a £20,000 allowance, they would pay no income tax at all. The old tannery. This solution would help not just pensioners, but also millions of low-paid workers who are currently paying tax on relatively modest earnings. It would take a huge number of people out of the tax system entirely, reducing the administrative burden on both taxpayers and the tax office. Young people starting their careers, people working part-time, people in low-wage jobs, all of these groups would benefit alongside pensioners. The big advantage of this approach is that it's universal and it treats everyone the same. There's no special treatment for one group over another, which avoids the fairness issues we talked about earlier. It would also boost people's take-home pay, which could help with cost of living pressures and might even stimulate economic growth as people have more money to spend. But again, there's a massive downside, which is the cost to the government. Raising the personal allowance from £12,570 to £20,000 would cost the Treasury tens of billions of pounds every single year in lost tax revenue. That's money that would have to be found from somewhere else, either through cuts to public services or increases in other taxes or higher government borrowing. In the current economic climate, with public finances already under pressure, it's very difficult to see how the government could afford such a generous increase. That's probably why official government statements have ruled out this option, at least for now. It's also worth noting that if the personal allowance was increased to £20,000 but then frozen again at that level, we'd eventually end up in exactly the same situation we're in now, just with higher numbers. The state pension would keep rising and would eventually bump up against the higher threshold, and we'd be back to square one. The third fix, and this is the one that's actually getting the most serious attention from policymakers, is to create a special additional personal allowance just for pensioners. This idea has historical precedent because the UK used to have age-related allowances that gave pensioners a higher personal allowance than working-age people. These were phased out years ago, but now there are calls to bring them back in a new form. The way this would work is that everyone would still have the standard personal allowance of £12,570, but if you're over state pension age, you would get an extra allowance on top of that, maybe an extra £1,000 or £2,000. Conservative Party figures, using projections, suggested that the new pensioner additional personal allowance would be around £1,140 by 2027 to 2028, which would save a pensioner able to use it in full around £228 over the course of the year. Tax.org.uk. This targeted approach would be much cheaper than raising the personal allowance for everyone, because it would only apply to pensioners. It would ensure that the state pension stays below the effective tax threshold for people whose only income is their pension, solving the immediate problem without creating a huge hole in government finances. It would also acknowledge the special circumstances of pensioners, who can't easily go out and earn more money if they find themselves short of cash, unlike working-age people who at least have that option in theory. The pensioner-specific allowance could be designed to rise automatically in line with the state pension, so that there's always a buffer between the pension amount and the tax threshold. This would provide long-term certainty and would prevent this whole situation from happening again in future years. However, this approach also has its critics. Some people argue that it's unfair to give pensioners special treatment when there are plenty of working-age people on low incomes who are struggling just as much or even more. Why should a pensioner with a state pension of £13,000 pay no tax, while a young person working full-time for £14,000 has to pay tax on the amount over £12,570? It also adds complexity to the tax system, creating different rules for different groups of people based on age. There used to be separate age-related allowances for pensioners until the coalition government phased them out, freezing them from 2012 to 13 until the working age personal allowance caught up with them. Tax.org.uk. Those were abolished precisely because they were seen as unfair and complicated, so bringing them back might be seen as a step backwards. And of course, there's still a cost involved, even if it's smaller than the cost of raising the personal allowance for everyone. So those are the three main solutions on the table. Make the state pension tax-free, raise the personal allowance for everyone, or create a special pensioner allowance. Each one has passionate supporters and strong critics. What actually happens will depend on political choices and priorities. Will the government prioritize simplicity and fairness across all age groups? Or will they decide that pensioners deserve special protection because of their vulnerability and inability to increase their income? Will they be willing to spend the money required to fix this problem properly? Or will they continue with temporary workarounds and patches that don't address the root cause? These are ultimately political questions that will be decided through the democratic process. But it's important that everyone understands what's at stake and what the options are. In the meantime, what can you do if you're a pensioner or if you have elderly relatives who might be affected by this? First of all, knowledge is power. Make sure you understand how much income you're receiving from all sources, including your state pension, any private pensions, any part-time work, and any investment income. Add it all up and see where you stand in relation to the personal allowance. If your total income is below £12,570, you don't need to worry about paying income tax. If it's above that threshold, you need to understand how the tax will be collected. If you have a private pension or you're still working part-time, the tax on your state pension will usually be collected through adjustments to your tax code on that other income. The tax office will reduce the tax-free amount on your private pension or your wages to account for the tax you owe on your state pension. If your only income is the state pension and it exceeds the personal allowance, you might receive what's called a simple assessment from HMRC after the end of the tax year. This is basically a bill telling you how much tax you owe and when you need to pay it. Don't panic if you receive one of these. Read it carefully, and if you don't understand it, get help. You can contact HMRC directly, or you can seek advice from organizations like Age UK or Citizens Advice, who specialize in helping older people with these kinds of issues. There are also local tax help services in many areas. You don't have to figure this out on your own. If you're struggling to pay a tax bill, HMRC can set up payment plans that let you spread the cost over several months rather than paying it all at once. Don't ignore tax letters because that will only make the problem worse, but do ask for help if you need it. It's also worth checking whether you might be entitled to pension credit, which is a benefit that tops up your income if you're on a low pension. Pension credit will rise again in April 2026, topping up a single person's income to £238 a week and a couple's income to £363.25 a week if they're eligible. Standard life. Many pensioners who are eligible for pension credit don't claim it because they don't realize they qualify, or they think the process is too complicated. But it's worth investigating because pension credit can make a real difference to your income, and it also unlocks other benefits like help with housing costs, council tax reductions, and free TV licenses for over 75s. There are online calculators you can use to check if you might be eligible, or again, you can get help from advice organizations. Looking ahead, it's clear that this issue isn't going away anytime soon. The growing debate around the state pension and the tax allowance reflects a deeper concern about fairness, transparency, and dignity in retirement. And what was once a niche issue has become a mainstream concern as more pensioners experience the impact firsthand. RamSafe. Politicians from all parties are being pressed to come up with solutions. Campaigners are keeping up the pressure. The media is paying attention. This is becoming a significant political issue, especially as the population ages and more people are directly affected. We could see changes announced in upcoming budgets, or we might see this continue to be a source of controversy and debate for years to come. What's really needed is a proper national conversation about how we fund pensions and social care for an aging population, and how we make sure the tax system is fair to people at different stages of life. The current situation, where the state pension and the tax threshold are on a collision course purely because of the interaction between the triple lock and frozen allowances, is clearly not sustainable. Something has to give. Either the triple lock needs to be reformed, or the tax thresholds need to be unfrozen, or a new system needs to be designed that takes pensioners' circumstances into account. Doing nothing is not really an option because the problem will just get worse year after year as the gap narrows and then disappears entirely. For now, the most important thing is to stay informed and to make your voice heard if you feel strongly about this issue. Contact your Member of Parliament and tell them how this affects you or your family. Support campaigns and petitions that are pushing for change. Talk to your friends and family about this so that more people understand what's happening. This is not just a technical tax issue. It's about the kind of society we want to be and how we treat people who have worked hard all their lives and are now in their retirement years. Every one of us, if we're lucky, will be a pensioner one day. How we solve this problem now will affect our own futures, as well as the futures of our parents and grandparents who are dealing with it today. The fixes are out there, the solutions exist, but it takes political will to implement them, and that political will often comes from public pressure and public awareness. So spread the word, get involved, and let's make sure this issue gets the attention and the action it deserves. I'm going to keep uploading videos on this exact issue, the state pension, tax traps, allowance freezes, and what's really coming next, so you don't get caught out later. If this matters to you, if this affects your future or your family, do yourself a favor and subscribe now. This channel isn't for everyone, it's for you. I'm going to keep uploading videos on this exact issue, the state pension, tax traps, allowance freezes, and what's really coming next, so you don't get caught out later. If this matters to you, if this affects your future or your family, do yourself a favor and subscribe now. This channel isn't for everyone, it's for you.